Hi, good afternoon, everybody. Now we can start. So today's topic is another topic that we've covered a couple of months back. It's more on the banking and financial services space. So if you've been on that particular webinar, then the initial slides will be of no use, and then maybe the Q&A will be much more interesting for you. So please do bear with me. I'm in a little bit of pain, so I might go a little slow, and I might miss a couple of sentences or a couple of data, which I think I'll cover up in the Q&A. Right. So this is always a slide that we start off with on Milestones2Wealth. Right. Milestones2Wealth is majorly a behavior program. It has nothing to do with what is the buy, what is the sell. It's not a platform. It's more to do with your behavior, where we set up milestones for you, where you are the one who's setting up milestones and we help you achieve that particular milestone. Be it 5 lakhs, 10 lakhs, 20 lakhs, 25 lakhs, whatever the case be, it's more behavior oriented, where we try to create a savings habit for you. And in turn, it leads to you creating an investing habit, right? So it's a behavior only platform, program, and it's not a platform that gives you buy and sell recommendations, right? So if you look at how long-term cycles work, more on behavior, and majorly it is two behaviors that do come in and impact markets. Is one is greed and the other one is fear, right? Ideally, what happens in a fearful situation is that investors tell you to go out and start selling everything. People tell you to sell off everything and stay away from the market. And when things are looking very optimistic, it's more from a greed perspective. Everybody is talking about buy, buy, buy. You read it in the newspapers, on YouTube, everywhere. If you go to your social circle, everybody will tell you, yes, buy this and buy that and buy this and buy that. Then you know that it's over optimism and things are getting a lot more hyped. Things are peaking out. And that's how cycles work from a long-term perspective. Of course, there will be shorter cycles. Like there will be a long cycle like this, and there will be shorter term cycles like within that particular long-term cycle, right? So where is Milestones2Wealth actually coming in to help you out? Now we work the opposite. We love when markets are extremely fearful. We love it when there's a lot of pessimism, because that's where we find that participating more actually helps you in times where there is over optimism, because you start averaging a lot more during the point of fear, right? So we manage your fear at that point in time. That's why we told you it's a behavior oriented program, where we are able to park your savings in the right place so you can have a stable and consistent journey towards your financial freedom, right? So participating more during pessimistic times is always going to be beneficial for you when the over optimistic times do come in, right? So Milestones2Wealth is completely invert. It's going to be where we participate a lot more in the fear factor. That is where more of lump sums would come in, more of SIPs would come in. A lot more participation would come in from your side, into areas where things are undervalued, things are looking good fundamentally, right? So that when the turnaround does come in into during that particular cycle, you are a very big beneficiary of it, right? So creating a savings habit that in turn lead to an investing habit. And that's how you start getting mature as an investor. That's how you start getting better as an investor to take further decisions going forward, right? About building wealth. So one such topic where fundamentals are strong, but sentiment is not. And inherently, it's a very important sector for economic growth, is banking, right? So let's look at banking and banks and why banking and financial services is the next big opportunity, right? All of the data that I've taken is all from mutual funds, and we are only going to be talking from a mutual fund perspective. So avoid stock related queries. ETF related queries are fine, but avoid stock related queries, right? So what's happening to banks and financial services, that we have come from a very bad cycle of high non-performing assets to low non-performing assets right now, right? And there is a lot of digital penetration that has happened in this space, and more users have come in into the system, right? So the as your economy starts growing, it's very important for banks and other financial services to be in very good shape. Only then innovation will start taking place. Only then everybody will start benefiting out of these services, right? So we are seeing private banks improving on their return on asset metric, return on equity metric, which again is a very good sign for growth, right? And putting on top of it is attractive valuations where they are extremely cheaply valued right now because of the negative sentiment that is around banks, right? Uh, Whenever there is a disruption that takes place, usually your brick and mortar companies, your brick and mortar sectors usually see some sort of negative sentiment, but that negative sentiment goes away in a long period of time as more and more innovation starts coming in. Right. So this is where we are in that part of the sector, right? Where things are extremely good from a fundamental perspective and it is cheaply valued. And there is a lot of innovation that is taking place, right? A lot of new companies have come up with their IPO, a lot of insurance companies have come up, a lot of platforms have come in. So rather than looking at just one part of financial services, we want to look at the entire basket. Right? That's why I told you no stock specific queries. But let's look at the basket because the basket is extremely interesting right now. Right. So if you look at financial services, our penetration across financial products is very low. If you compare to China, or you compare yourself to Korea, or you compare yourself to USA, right? There we are completely underpenetrated. Look at our mutual fund AUM to GDP. It's about 15 or 16 odd percent. But here you look at Brazil, it's very high. Right? You look at China, it's still much more better than us. You look at Korea, a very small nation, but they are extremely strong. They do have some core competitive advantages. Yeah, it's 40%. Look at UK, right? You look at the insurance side, right? Then you look at credit. So everywhere on all metrics, we are very underpenetrated when it comes to financial services. And this is the growth that's there, right? That's why you're seeing a lot of emphasis given to everybody needs to be on the right place of insurance. ULIP can't work anymore, right? But everybody, we educate investors to say, yes, this is more important for you than just doing that. It's not about returns. Insurance, you need to think of it as a contingency. Likewise, as more and more investors, as more and more savers start getting the right financial knowledge, you would be able to start taking better decisions for yourself. That again would lead to an improvement in productivity of those particular areas of the economy. Right. So we are completely underpenetrated as a country in terms of these financial products, and that is why we see a huge runway for growth in this sector. Right. Now, if you look at how big that particular opportunity is, if you look at that, it's about 4 lakh crore, right? 4 trillion plus, right? And majorly, if you look at how things have worked from a fundamental perspective, you see your insurance companies have grown at a 24% PAD CAGR in the last 10 years. Your exchange is 21%. A lot of more participation has happened. Right? Your AMC is 22%. So it's not just pure public bank or private banks anymore. Now we want to look at the entire basket because that entire basket has become a lot more interesting. They've become a lot more important. Right. Now that opportunity is about 4 lakh crore, which is a huge sum. Right. So rather than just buying 2.5 lakh crore of the entire sector, which is purely banks, here we are able to buy 4 lakh crore, which is a big sum. Right. And that's the size of opportunity that's there for you. Right. I also see a question in terms of where will we see better performance, banking, financial services, or pure play banking? No, it's the entire pack. That's what we're discussing right now, is the entire pack. Right. Yeah. So if you look at credit in India, uh, credit will grow is growing fast as the penetration is sort of improving. As more and more people start taking on leverage, things will start getting a lot more better. But if you look at credit growth is very important to nominal GDP. Right. If you look at it, there's a clear trend. As the credit growth goes up, you see nominal GDP also starting to do well. Right. That's because we are borrowing and then we are putting in more assets. There's a big cycle that takes place. Right. Private consumption is actually taking place in increases as credit growth starts to go up. Right. That's where your entire retail pack, your consumption pack starts going up. We see as people start earning a lot more money, they will be able to appetite more and more credit, more and more leverage. And it's not that we are not going to be, paying off our debt. Yes, of course, Indians are such that we don't like to have much debt. We do want to pay off the debt. So you are working with people who are taking on debt, but also very sincere in paying it off back, right? So credit growth is extremely important to our country growing, right? That actually shows that yes, there is a good amount of demand that's coming, and people have the appetite to take it up. Right? That's about credit growth. Now, if you look at majorly, right, when you see yes, people have to give out that credit, they would give out that credit only when their ratios are very good, only when they are able to weather such risk from a banking perspective or from a non-banking financial services perspective. Your fundamentals need to be extremely good. And right now we have come off a cycle. If you look at 2018, 16, 17, and 18, we saw the IL&FS crisis happen. We saw a lot of companies go to NCLT, and then ultimately they were bought out. And the banks did have to take a lot of haircut. Second, they were recapitalized. Government was recapitalizing all our banks, and that is what led to our banking system benefiting out of such activities for their fundamentals to actually start getting a lot more better, right? So net NPA started to reduce drastically from there, but that entire period of when your NPAs were extremely high, banks were trading at a very high premium at that point. That's where you saw time correction taking place. That's where you saw a lot of banks in terms of stock performance not do well. So if you check from a 5-year perspective onto banking, the performance would be abysmal. It would be very bad. Right. Even during COVID, when the world is shut, everything took place online, and our banks did not have much of a problem compared to other banks all across the world. So that actually shows the inherent strength that's there in our banking system. Right. So that actually led to increasing return on equity metrics. So now if you see private banks and public banks, their returns on equity versus Nifty are much more higher. Right? Nifty is about 15%, and now we are inching up. We are inching up to 15%, and then eventually, as things go well, it would be much more higher. But at the end, so 35% of the entire Nifty is banks. So you would see an improvement across the board, right? But just from a fundamental perspective, for you to go out and start lending, your banks need to be in a very good shape, and now they are in an extremely good place, right? That again would spur private consumption. It would spur up private capacity addition. That again would spur up consumption. So if you remember, we have done 2 webinars on consumption and how these two sectors are completely interlinked. Right? I had done one on. I have not yet done one on infrastructure, but uh, in- but investors on the program would know what we're trying to do in the infrastructure space. Right. But these two sectors are completely linked. For economic growth to take place, there are a couple of sectors that are going to drive that particular growth. And this happens to be one of those sectors. Right. Now, if you look at our loan growth for bank, we reached a peak in 2006, and then from there on, you have not seen much loan growth at all in the entire system. Right. But if you look at consumer loans have hit an all-time high. The RBI is also worried about unsecured lending, right? But the last wave of capacity addition, the last wave of infrastructure cycle took place in 2000, 2010, that entire decade, right? Golden quadrilateral. You saw China preparing for the Olympics. They were spending a lot more. There were cities being built overnight. So there was a good wave, and that was leverage fuel right now. And then you saw 1 decade of bad. It was a bad cycle for infrastructure, and that's how you saw lending started to go down. There was no loan growth that was happening. Right. Now, on the flip side, the government's focus is now more on the infrastructure side, which means you build capacity leads to more consumption. Leads to more consumption, everybody starts making money. Everybody starts making money. Everybody has to save that money, right, into financial products. So that's why everything here is sort of interlinked. Right. So now you are seeing a big uptick in loan growth, and that we've been seeing since 2022, since the government has said, yes, we are going to push on infrastructure, and that's what's happening right now. Right. So what happens when such scenarios take place where you are having loan growth, you are having good amount of loan growth, your credit cost is somewhat lower, so your return on equity starts improving drastically. So we've had a bad cycle, and now we are back up to 2008, 2009 levels, where you're seeing a combined ratio of somewhere around 12.5, 13% odd, which is expected to improve. So you are seeing that things are taking place. Things are taking place very slowly. It's a large sector, but nonetheless, things are taking place as expected. Right now, this is very important. Now, if you see, banking and financial services forms 38% of the profit pool of the entire 500 companies that are there in the market. Right. but it is only 26% of the market cap. So now you know how big this entire profit share pool is and how much currently it is trading at, right? Plus, in the last 10 years, the profit growth for the sector has been somewhere around 17%. But X banking, which is your top 500, X banking is only 10%. Right. So profitability has been growing at a faster pace. Second, it still happens to be compared to that profit pool, it still happens to be a very small percentage of the entire total market cap. Right. So if you look at the large caps, uh, 39% is what is the share of the profit pool among the top 100, whereas the market cap is 28%. If you look at the mid caps, it's 38%, and again 21% is the share in market cap. If you look at the small caps, share in profits is again 28%, but your market caps are fundamental. So there's a good chance that yes, things would look extremely good here on from a performance perspective because they have delivered on profit pools. They have delivered on profit metrics. So yes, there is a big chance that from here on, yes, it would start reflecting reality. Right. This is a very, very important slide. If you want to gauge fundamental values, you always have to look at profit pools. And here, profit pools are growing at a very fast rate compared to the rest of the companies that are there in the entire index. Right. But it doesn't get valued that high. It doesn't reflect that sort of performance in terms of its current value now. Right. So there's a lot of scope for growth. Right. Like I said, there is an increasing share of private banks alone, right? You've seen a tremendous growth in private banks the last decade. Now public banks are catching up. But if you look at it from a private bank perspective alone, right, which is where a huge chunk of our deposits also lie, right? If you see in the 15 to 23 period, you saw private bank pad almost the same as Sensex pad, right? But during 13 years back, right? During the 2010 to 2023 period, you saw private bank pad growing extremely strong compared to your Sensex pad. So there is a big catch up that has happened across the board. And that's why you're seeing in the last 5 or 6 years, banks are not being valued as high as what they used to. And the expectation is that they would be able to outperform the total broader market in terms of profit growth. Right. So let's see what's happening going forward. As of now, results that have been coming in, they have been extremely strong. Yes, there is an uptick in cost, but nonetheless, they have been strong. Right. So this is why you see this underperformance coming, and the current underperformance is much more lower than previous history. That is, the last bad history was somewhere around, your global financial crisis. And if you look at that, is almost at that same level. Your underperformance versus Nifty 50 is near your global financial crisis bottom, knowing that yes, profit pools have grown at a faster rate than the broader index. Right? They happen to be a small chunk compared to that profit pool. They're not being as highly valued as what they used to be. Right? Knowing that yes, there is enough scope for growth that's coming in here, yet there is underperformance. Right? So this is that period that investors should be able to take advantage of. And anybody on the program would know that yes, you are getting a lot of messages, you are getting a lot of calls saying, yes, what is it that, where are, if you are interested in doing lump sums, where is that opportunity for you to go out and start doing lump sums, because you can't do across the board, right? From a saver's perspective, yes, you have money that you have saved up. And then where is it that you need to create that investing habit right now? If you want to go and start doing lump sum, where is it that you can hit a six on this particular ball? It's here, right? Where is it that you want to take a single run, or let's say, 2 runs or so? That is the other part of the market, right? But in terms of an investing habit, when you talk about taking lump sum opportunities, you always have to take lump sum opportunities only when it is extremely cheap, only when it is showing that yes, it is near a very strong bottom with enough growth that the entire sector can take advantage of, in turn for the investor to take advantage of, right? So this underperformance uh, should be taken advantage of. There is definitely a turnaround that is going to take place, that yes, you will benefit out of. Now, if you look at why we are looking at the entire basket, like I said, there are many businesses that are hard to replicate right now. They've become a lot more bigger, right? And for them to be bought out also, it's going to be at a high premium. So the space has opened up. So everybody is going to compete at their best. They are going to get market share, and they are going to grow at the same time, right? So this is why we want to look at the entire pact and not just parts of that entire sector, right? Uh, See, if you look at a medium flexi cap fund, they will hold 70% odd in financial services, particularly with an overweight towards banks, right? So is there a reason or why we should look at a banking fund? Of course, yeah, because it's 100%. A flexi cap fund might not have that much, or let's say a large cap fund. Yes, they would be overweight on the banking side, but they would not have the entire pact. And what we are looking for right now is to look at the entire pact and not just parts of the market. Right. Now, if you look at the valuation compared to Nifty, it's trading at a very deep discount. This is a couple of months back data, but this is the right data. It has not changed much. So it is trading at a very high discount compared to your Nifty. Right. So Nifty Financial Services Index, which is the entire pack, is trading at a much higher discount than it has traded in the past history. Right. So this indicates that yes, there is enough margin of safety for somebody who wants to take risk, right? Taking risk doesn't mean like high risk doesn't mean high return. When we talk about risk, we only talk about, okay, I want to take the least risk and still make the most money, right? So when we look at the least risk sort of metric, yes, here there is enough margin of safety for, and they have a long record in terms of one, operating in this environment. Second, in terms of showing that yes, they can grow in any sort of environment, right? So there is enough margin of safety for investors to take advantage of. It checks enough boxes to say yes, this is a sector that's not going to go out of fashion. It is going to start getting better in terms of fashion. At the same time, there is negative sentiment that's going on, so there is enough reason for you to be contrarian. Third, yes, it is giving me enough margin of safety because it is trading at a discount, plus it has underperformed. But fundamental level, it has shown a lot of growth. I just have to wait out for sentiment to take place, right? That sentiment can come in 3 years. That sentiment can come in 5 years. That sentiment can come in 7 years. We've seen it in public sector entities where it came only after 6 years, right? So investing habit is more about discipline. It's more about patience, and it's more about having this sort of long-term perspective that I will stay put. Only when it's the right time for me to take out that money, I would. And that's where we come in to say, no, is it the right time? Yes, it is the right time. Right now, if you look at if you look at any sort of metric, right? In any sort of metric, they underscore that of Nifty, which again for us is a again is a sign for us to say yes. Is it the right time? Yes, definitely it is the right time for us to go and start taking that advantage of this current negative sentiment that's going on in this entire sector, right? So now I'll open the floor for Q&A, and just refrain from asking me stock specific questions. You can ask me any other questions regarding the sector, regarding of what you feel also. Uh, 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 I think that's about it. Nothing related to stocks, please. Okay, would like to know what the P/E ratio of the sector is. Usually, yeah, if you look at today from a current perspective, your banks, and so you look at private banks, don't look at public banks. Public banks have been trading very cheap, but it is trading somewhere around 16 times or so, 16, 17 times. You want me to show you the last graph? This one. Okay. I've put in the number. So I mean, I'll put the number in after you're done seeing this. Now, all of this is public data. What do you think about public sector banks? Public sector banks have had a great run up and have had a huge run up. Anytime there is a an announcement where the government wants to focus more on infrastructure, you would see public banks do extremely well. And they did have a lot of non-performing assets that they cleaned up, so that worked in their favor. And they were first in line to give out those particular loans and to start up loan growth. Right. So the next wave has to be across the board. Private banks would start participating in them. They already have started participating in them. So you would see a big catch up taking place. But right now, in terms of public sector banks, they look like they're very expensive. Should we start SIP or just only lump sum in MTW? That's why I would put this number. If you're not on the program, get in touch with us. We will help you. We will look at how much you're able to save. We will look at, all your expenses, make sure that yes, you are on the right track, and help you in terms of direction as to for you what is more beneficial, whether it is SIP or whether it is lump sum, right? So investors who we have worked on the program do a mix of both, right? This is based on their savings ratio, not on yours, and on their risk profile and on their goals. But they do a mix of both, right? And we prefer it that it is a mix of both, because one, SIP is to create that sort of habit for you in terms of consistency, in terms of discipline, and lump sum because everybody knows that they also want to every day see their screen and say, yeah, no, 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 I want to take advantage of this. So yes, we do like it when your SIPs are topped up with lump sums whenever there's an opportunity. And we do get in touch with you regarding the opportunity. So the entire team works very hard to make sure that you are invested at those right levels. Banks have a lot of trouble in terms of technology. No, they are improving their technology. They were behind, but I'm sure that there will be a catch up. You're already seeing catch up taking place. If RBI starts to cut the rate, then NIMs will come down. What's your view on this? NIM is already down, uh, and it has normalized, so don't worry much about it. Second, let's see if RBI cuts the rate or not. It depends on what the developed nations are doing. In terms of what the developed nations are doing, for them, inflation is a big concern. Let's see if they can cut. They have promised to cut 3 times, but I don't know if they would cut 3 times, maybe once. That I think I covered in the last webinar, which was more debt oriented. So please do go on YouTube, go to the live section. You'll find all our webinars and then just pick up the debt ones. More or less, it will be similar. What do you think about insurance? Insurance in India is highly underpenetrated. Now, when the new insurance policy comes in, it would open up the game for everybody. So everybody can start selling. So a life insurer will be able to sell health insurance, which is very good for the sector. I think it would be very inclusive. A lot of change would take place because we are highly underpenetrated. We have a good runway for growth. See, in terms of you are only looking at one metric, right? But when you look at businesses, you have to look at all the other metrics as well, right? All the other metrics are fine. Things are looking good, except for couple of businesses, couple of banks that are very large that have become extremely large right now, and they would go through their own issues to manage costs, right? But more than that, things have looked very good. Only when sentiment changes, when you start seeing things happen. We've seen this in public sector, we saw this in infrastructure, we saw this in commodities. We are seeing this in gold. We saw this in silver, and I've done webinars on commodities as well. So anybody who's on the program would have now benefited completely of that entire call, right? But right now things are extremely good, right? They have been already under pressure, and that has been weathered by the entire industry. So and they've been weathering many such issues very, very effectively. So you have to give them that credit. There is no PMS just for PSU. Uh, Sphere is a thematic product, so Sphere has taken advantage of such themes. What is the most interesting sector from the whole of BFSI? Insurance is extremely good. Your asset management companies are looking good. Uh, that's it. I think my priority would first be towards insurance. Can we invest in ETF like BFSI? See, I've always had this. I wouldn't say a problem, but in terms of passive products, right? Passive products are backward looking and not forward looking, right? In a way, they are momentum because what comes into the index is after a huge chunk of performance that takes place, right? Developed nations has a lot of innovation when it comes to passive investing, they have products, sub products, leverage products. They have a lot more innovation that is taking place there. We are still very nascent in terms of passive, right? Uh, you need active management in sectors and thematic funds, right? Because in a sector or a thematic fund, if something comes in into the index, or because the ETF would replicate the index, performance has already come. So you are not buying first, you're buying last, right? So I would say always to look at active management when it comes to sector and thematic, because it's still nascent. As more innovation starts taking place, you would see a good amount of uh, uh, you would see good changes that are taking place in the passive investing, on the passive investing side. But active management is very much required when we look at sectoral and thematic. Right? Now there are many indexes that have come up on NSE, but again ETFs would again depend on the demand that comes in for that particular ETF. You're seeing a lot more momentum based products coming in. You're seeing smart beta products coming in, but the industry is coming up with newer and newer products, coming up with newer indexes, which is very good, right? So that part has not come down, it's just improving, right? So that is a very good sign for the growth for passive investing, right? A lot more as we start getting mature as investors, we would know how to use these particular products, right? Sphere has taken advantage of passive investing because there is a tactical play. It's not, it doesn't, yeah, we manage it extremely tactically, right? So we've been able to benefit out of that. So as you start getting mature, as you start working with advisors like us, you would understand how ETFs are structured, how they should be working, and how they're currently working. Right? They are momentum. If in a way they are momentum based, they are backward looking and not forward looking. When you want to grow, when you want to create that sort of wealth in terms of, to meet your future goal, it has to be forward looking, not backward looking. What are preferred mutual funds for BFSI? Get in touch with us. I've put in the number. Just send us a hi saying, yes, I want to invest in banking, and somebody from the team will get in touch with you. Yeah, RBI has been extremely strong. They've been very strict. They don't want to give out chocolates to anybody. It's not only private banks. It's been across the platform. It's been NBFCs. They've gone to exchanges. They've gone to fintech companies. They've gone everywhere. I would say that you take up. So we will help you in terms of taking up a broader based approach. But it's better also that if you take a broader based approach, because here you will get a flavor of everything. There are good indexes. There are specific index funds that are good in the banking space, but that is banking alone. You will not have everything else, and we would prefer to have everything else. See, this can we exit PSU and defense fund as it is overvalued and invest in banking fund? Depends on your risk profile, depends on your goal, depends on your entire investing technique. Now, when you ask such question, you have to understand that it's not one size fit all. It's for you. It has to be tailor made for you, right? So get in touch with us. We can review and see, yes, what is the best that we can do. But when you say, can I exit or can I buy this? It depends on your particular goal. It depends on your particular risk profile, and it depends on to what you're saving for, right? So just send us a hi with your particular query, and somebody from the team will definitely get in touch with you. But it has to be specific to you, not to everybody else on this webinar. It's specific only to you. Please read out the question and answer. We are not sure. Yes, I want to. It's just that is all. I'm in a lot of pain to actually. I'm struggling, but I'm doing my best. So thank you for that feedback. I'm doing my best. Uh, if one bank has a market penetration technique to lend loans, the other competitor will copy it right away. In this scenario, what is the possibility of creating a moat for a bank? If one bank grows, the other immediately. That's what has happened completely towards NBFC. And NBFC started to get a 7, 8 times multiple over it, right? Because they took a segment of the market, the segment of the entire loan book that they were not focusing on, right? So structurally, what is a moat? It's either a competitive advantage or it's a mix of okay, somebody can't come into my territory. Why? Is because I built a very big fence, right? Just because there's no fence doesn't mean that there's no moat. If there was no, if there's no fence, how is it that everybody is making money, right? If everybody is making in money, yes, then it's a sector that has enough. It's bright enough for everybody to start making money. Is it easy enough for more competitors to come in? Uh, right now it looks like there are, because Geo does want to come in, right? So just from a pure mode perspective, that way there are very small, very specific industries alone that you can invest in that trade at extremely high multiples. So you will not be able to take advantage of that, right? What you need to look for in a moat is size, right? And here you have size advantage, right? You have muscle, you have size advantage. You have companies that are building competitive advantages within that environment that they're currently operating in. Competitive advantage. Moat is completely different. Right? Everything has to work out for them to become. But if they have that intensity, if they have that that advantage that say, yes, I'm still going to fight, I'm still going to compete, then it's worth looking. But everybody has sort of done this today. If you see your fintechs, they are coming up with loans, they're giving out loans, they're giving you small loans, small ticket size loan, which is bad for a small finance company, right? Again, there is NBFCs that is going to miss out on this. So there are parts of the market that are being taken advantage of on on the lower side of the curve and on the higher side of the curve, right? But it's healthy that yes, everybody is starting to make money. When everybody is that making that sort of money, then yes, you should look at the basket. Yes, CASA ratio has been improving. Uh, what are your service charges? For Milestones2Wealth, there's no charge. We do it via regular mutual funds, and we do get some commission from the AMC. But we are a completely research-based organization, and for us, commission is not a problem, because here you see expense ratios have been coming down, which means the commissions also are coming down, and it's not something that drives us or motivates us to take a decision. What motivates us is to get everybody to 1 crore, and that's the goal that we have for every investor that we work with on Milestones2Wealth, is that everybody should be a millionaire. Right? That's the goal, and that is what Shams has also set as a target for everybody. That anybody who works with us should have that mental ability, should have the willingness to say, yes, I'm going to save a lot more, and in turn, I'm going to be disciplined. If I'm not, yes, you guys are here to help me. You guys are there to take care of me. But ideally, is to build a corpus of 1 crore. For banks, shouldn't we look at PB rather than PE? Yes, you can look at PB. You should look at PB. If you look at PB here, there's a big discount to PB also, right? So yes, book value loan growth means book value will grow. Book value will grow means, yes, in relation to that, uh, they usually trade at 3 times, 3.5 times. So naturally, they should re-rate. Valuation is very abstract in the PSU segment. A view on this. My question to you: why do you feel valuation is? What are you seeing that you say valuation is good? Yeah, I just have a cut on my tongue. So yes, it's being taken care of. Thank you so much. So I'll take up that PSU question. See, in terms of so public sector has majorly been a commodity oriented uh, sector. When the earnings come in, so if you look at PE, uh, when the E doesn't come in, your PE looks higher. But suddenly in 2 years, when your E just comes in like a shopping cart where everything is growing exponentially fast, then your E goes up in relation to your P. So it looks low. So even if the P goes up, but still in relation to the one that has already come in your E that has already come in your earnings, it still looks low. So For public sector and commodity oriented companies, flip. When your PE is low is when it's actually expensive because you're looking at earnings, you're not looking at the ratio. Understand the ratio, right? It's your E that matters more than your P, right? When the earnings come in at a faster rate, then it optically it'll look low. But when the E doesn't come in, it'll optically look high, which means there's scope for earnings growth and there's scope for earnings de-rating. That's how you should look at things. So yes, uh, your E in PSU has come in very fast. So in relation to PE, it looks like it's low, but there's exponential growth that investors have been able to take advantage of. We have also been able to take advantage of it on thematic products like Sphere and on the mutual fund side. PE and PB valuations are discounted. Uh, Again, B is your loan growth as your book starts grow as your loans as you start giving on more loans naturally it would start coming in. But I don't know what you mean by P and PB valuations are discounted. We have the floor open for another couple of minutes. If you do have any questions, so please put them in. But if you're not on the program, just send us a hi, get in touch with us with whatever specific query you have. And our team will do their best to make sure that yes, all of your queries are met and we are able to put you on that right path of creating a savings habit and further on an investing habit. How are you seeing small banks growth compared to larger banks? If the larger bank says, hey, I'm going to attack you, then there's no point of a small bank. So there's healthy amount of you live, I live, both of you make money. I would say mutual funds. Don't waste your time on direct stock investment unless you have a lot of time. I don't think a lot of people have time in terms of understanding fundamentals, reading about everything. Here on the mutual fund side, you are just paying somewhere around 1.5% as expense ratio, which is already factored into the NAV that comes on a daily basis. So you are getting a proper research team that works day in, day out. Second, you have a very experienced fund manager who's taking care of the entire portfolio. So why would you pay the brokerage firm anything where you can get cheaper advice in a mutual fund? So I would always pick mutual fund unless and until you have the skill and the time. I don't stick to direct stock investing. Last 2 years, a lot of investors who came to the market were able to benefit out of it, but it's not sustainable. And as savers, you need to look at sustainability. You need to look at consistency, and you need to look at places where the scope for me to lose my wealth is lower. Right. So naturally, you should stick towards a basket, and that basket is offered by mutual funds at a low cost. So you should stick to that. So that depends on the overall portfolio, how much portion can we park in a banking and financial services fund. That depends on your risk profile. It depends on your goal that's coming up. So just send us a hi, and somebody from the team will get in touch with you to make sure how much is good for you. But just send us a hi here. Thank you. Thank you for joining in on a Saturday afternoon. If there are no further questions, then we'll close. But just send us a hi here. Milestones to Wealth is completely behavior oriented. You're seeing the quality of the work that we are doing. Anybody on the program would be able to vouch for us to say that yes, we are working for the investor. Everything is tailor-made. Everything is for the particular individual investor, and nothing is one size fit all. Right? It's all for you. It's all made for you. Right? It's all based on your goals, your risk profile. So send us a hi, and let's work together and make sure that we get you to that 1 crore target. And thank you so much for your time, guys. Have a great weekend ahead.